What's going on, everybody? It is Wednesday, June 22nd, 2022, and it's time for this week's 2 Minutes with Jeff. So, last week we got more bad news from Fed Chairman Jerome Powell, and he came out and raised interest rates actually higher than what was predicted or what the initial plan was. What the Fed had been saying was they're going to be raising rates usually like half a percent at a time, and they decided that inflation is a little bit higher than what they predicted, and so they decided to raise the rate 75 basis points, which translates to about 3/4%. So that was kind of the major news last week. The inflationary numbers the week before were higher than expected in May, which turned out to be 8.6%. And I think that before they predicted, or the previous month, was 8.3%. So that's not good news. And inflation, it looks like it's here to stay for the foreseeable future. And we kind of knew that this was going to happen. A while ago, when they were printing money, sending money to everybody, the cost of everything were going up. So now it's just a matter of them trying to get this under control and being able to come up with a plan to kind of stabilize pricing. One of the things that a lot of people look at is the CPI, which is the Consumer Price Index, and that is a metric kind of gauging off of consumers, which are the end users. If you go to buy gas at the gas pump, the people that are filling up the gas tanks, we are the consumers. So, but there's also a PPI, a Producer Price Index, and I think that's a little bit more of what we should be looking at as far as whether these inflation numbers are still going to be going up. And the Producer Price Index actually shows the cost for the producers. So if these numbers still continue to rise month over month, logically, that number is going to get passed down to the consumer. So the producers are not going to be just eating the cost of these increases. If something costs more money to produce, if it was $1.25 last month, and between the materials and everything else, it's $1.30 this month, they're not going to eat that cost. They're going to pass that cost down to the consumer. So the consumer ultimately is going to be, we're going to be paying more for whatever product that is. So I want people to focus on the Producer Price Index. The CPI is okay, but the PPI is something that can kind of foreshadow what's going to happen in the end user, which is us and the consumers. So that's a little Econ 101 kind of stuff. But I mean, it all ties back into the real estate market and mortgage cost. And obviously that's the main factor of what inflation and, when the Fed decides to raise the rates, which they're still going to continue to do throughout the year. And I've been saying it pretty consistently almost through every 2 minutes with Jeff that they're going to continue to raise the rates. I still believe that they're going to end up somewhere between 7 and 8% at the end of the year. It looks like they're right on track for that. The rates have gone up a lot since the beginning of the year, almost double. So it's been super accelerated this year. I didn't really think that they would go up this fast, but they did. So it'll be interesting to see at the next meeting if the Fed decides to go back to their plan of only raising the rates at 0.5% or 50 basis points, or if they're going to be a little bit more aggressive, like they were last meeting and last announcement, and raise it 75 basis points. So it'll be interesting to stay. The stock market's been getting torched. I think last week it closed, down for the 11th week out of the past 12 weeks. So, the stock market, is not doing great. Really the only thing that's still kind of doing good is real estate. So the prices are still holding. We're not really seeing a lot of price decreases. I'm not really seeing that, but it's starting to slow down, just like I've been saying. Mortgage rates are going to continue to go up. It's going to squeeze a lot more buyers out. It's going to squeeze. If you remember on the last 2 minutes with Jeff, we talk about the tiers, the buying tiers. So the lowest tiers, your entry level, your first time home buyers, your your buyers with the lower budget. Those are the people that are going to feel the squeeze when it comes to rising interest rates. So it's unfortunate because it seems like that's the highest demand. That bracket is the highest demand for housing, and those are the people that are getting squeezed. So that could create some sort of problem or some some sort of issue that the affordable housing is becoming less and less affordable. So I mean, yeah, it's a lot to digest. It's a lot going on. I'm still going to advocate now for buyers that it's really a good time to get back in the game, especially if your budget can afford it, even with the highest interest rates. It's still comparatively low to historical numbers. So buyers, it's swinging in your favor. The pendulum is going back. Sellers, still a good time though, because prices are stabilizing. We're not getting the crazy bidding wars where you're getting $25,000 over asking and all that stuff. We're just starting to slow down a little bit. So buyers, good time. Sellers, still good time. I would say a little bit more better time for buyers than sellers right now. But, transactions happen every single day, and it's not going to stop. Doesn't matter what happens in the economy. It's still going to keep going. Real estate's still going to keep going. It's just a matter of where you are personally and what goals you're trying to accomplish. So that's it. It's kind of been repetitive. 2 minutes with Jeff over and over and over, but like I said last week, with Jerome Powell coming out and raising it 75 basis points instead of the anticipated 50, it was kind of it was interesting times we're in for sure. So that's all I got. And if you feel free, leave a comment, send me a message, call me with a question, whatever you got to do, I'll be here. All right, till next time. See ya.